Hello, welcome to this episode of Rich Insights. I'm Don Rich, Head of Investments for Esoterica Capital Markets. Today's topic is on the importance of asset allocation. All right, it may not be the sexiest topic in the world, but it certainly is important. Now, particularly in this time, right now, we have a situation where both tails are very large. The possibility that this tremendous equity rally, the buy everything equity rally, could continue is non-trivial, right? There's still a lot of cash sitting on the sidelines that could propel this thing higher, right? And obviously we could make a V-shaped recovery and things could go back to normal, right? That's the right tail, right? That's the good outcome. But at the same time, the left tail, the very bad outcome, is also non-trivial. It's quite large. Right? The slowdown materializes less quickly than we anticipate. We have a second wave or a resurgence in the virus, or maybe we have some second order effects to the first wave of the virus. Now, those second order effects may be, a tidal wave of bankruptcies that people are talking about, particularly with small businesses. Could be credit downgrades, crisis in the commercial mortgage-backed market. There's a variety of pretty bad outcomes that could materialize, right? That's the left tail. So we're in an unusual situation right now where both tails are very heavy, right? So what do we do about that? Well, let's go to the charts. Let's take a look. All right, here we're looking at year-to-date performance on three portfolios. All right, this brown line, this orange or brown line here, is the U.S. bond portfolio. And you can see the behavior of this over the course of the year. And as of the close on Friday, June 19th close, it was up almost 6%, right? 5.9% year-to-date return. That's the bond portfolio. The blue line is the S&P 500. Now, it's had this tremendous recovery, and at one point it actually even became positive on the year. But it's now currently down 3.2% on the year, right? So it was down substantially, 30+%, and it's recovered most of that, so it's now down 3.2%. Well, a very simple mixture of the two. Well, if you put 60% of your money in the S&P 500 and 40% in the ag, you would have done much better. Right? 1.7% would have been your year-to-date return. All right. Again, that highlights the importance of asset allocation. Bonds are not the most interesting asset class in the world. They're hard to brag about with your friends at the gym and brag about online and Facebook and so forth. But they are important. And we're going to see it's not only this year. In general, it's true. Right? We underappreciate the importance of asset allocation. All right. Now, it's not only in the U.S. either. I want to highlight that as well. Let's take a look at this next chart. Here we have the year-to-date performance of several emerging market asset classes. And here on the blue line, we have dollar debt. All right. So this is debt issued by emerging market entities. All right. So sovereigns and corporates. And it's down 50 basis points on the year, right? It's barely in negative territory. All right, so that's the dollar debt. Then there's something called local debt. These are debt securities that are issued in the local currency. All right, and you can see those are down 4.3% on the year. So we have dollar debt and local debt, both in negative territory, but rather minor negative territory. Compared to EM equities, down 10.2%. EM currencies, down almost 11%. Again, bonds are beating stocks, not just in the U.S., but outside the U.S. as well. And the importance of this, again, it's not limited to this year. That's what I'm trying to stress. Maybe the easiest way is just to show you the results. Let's go back for the last 20 years. All right, this third chart here we're looking at. The last 20 years, had we invested $100 on January 1st, 2000. So we start back here, January 1st, 2000. We invest $100. We can either invest in the S&P 500, right? 100% in the S&P 500. That's our blue line. The black line is the U.S. bond portfolio, the U.S. aggregate, and then the 60-40. And again, what you see is throughout most of the last 20 years, and in fact now, the 60-40 portfolio has beat 100% equities. Wow. Just stop and think about what the fat guy just told you. We just came off the longest bull market in capital market history, right? From 2009 to February of this year, the longest bull market in history. And yet, a 60-40 portfolio over the last 20 years still outperformed, even with the longest bull market in history. What's the second piece of information there? This tremendous rally we've had since the March lows, the tremendous rally, still it hasn't been enough. A 60-40 portfolio has actually beat both of them. All right, so what's going on here? Why is this? Why, this is sort of the magic sauce. Why is it? Why does it work so often, so long? By having a 60-40 portfolio, you have enough equity exposure that you get to participate in these bull runs, right? And when you have economic expansion, you get to participate in the bull runs. But you also have enough protection with your bond portfolio that during the pullbacks, they protect you. So again, the February and March pullbacks that we saw this year, bonds greatly outperformed. And then we had the rally in equities. Equities were outperforming. But the combination, a 60-40 mix, worked really well all the time, whether we're in a dislocation or whether we're in a rally. Now here is the real butter on top. All right, this is when we're cooking with bacon grease here, folks. Not only does the 60-40 portfolio tend to beat an all-equity portfolio. You've just seen evidence. It beats it this year. It's beat it for the last 20 years. It beats it a lot. Right? Not only does it beat it, just stand up on an absolute basis, it wins. But you incur about 30 or 40% less risk. That's the kicker. Right? In other words, it's just a much smoother ride. If you're trying to build wealth, again, the build wealth part comes from the equity part. Preserve wealth, right? Wealth preservation comes from the bond part of that. You put two together, and you got a pretty nice cocktail there. Now, the last thing I want to highlight is the importance of the current market. And what I mean by that is we've got this really unbelievable, unprecedented amount of liquidity, right? It's come from these fiscal packages, whether it's payroll protection, small business loans, right? All these fiscal plans or the grants from the government, right? So we've got all that fiscal money coming into the system, plus we got all the liquidity that the Fed's introduced. All right, now that's given rise to this rally, right? This huge rally we've seen this year. And that means, obviously it could keep going, and that means that's what's driving the right tail. But the problem is valuations are really getting nuts, right? We are back to bubble territory by a lot of metrics, most metrics, in fact, from a valuation perspective. Markets are overbought in the short run, and they're overvalued in the long run. That's a bad combination here. And also, when we're in this very low interest rate environment with tons of liquidity, it gives rise to what's called zombie companies, right? Companies that can stay alive a lot longer than they should, right? A lot longer than they normally would, because the disciplinary force of the market's just not there, right? They get a get-out-of-jail-free card is what it amounts to due to the unbelievable amount of liquidity in the system. So that creates these zombie companies. Now, these zombie companies have now given rise to what my predecessor here, show you a chart here, or an article from CNBC, my predecessor, Mohamed Alarian, calls zombie markets. All right, so we have went from zombie companies to potentially zombie markets where prices are so distorted, right? The price discovery process is so impaired that prices have become detached from the fundamentals. All right, that's what we really have to worry about. Now, it doesn't mean they can't stay detached. Again, that's the right tail. In this crazy environment, I particularly think it's a crazy environment. Maybe you do as well. But that's not to say this party can't go on. And that's the right tail. They could stay detached. But eventually, fundamentals are going to be important again. So, again, asset allocation is your recipe. Keep enough equity risk on to participate in rallies. Keep enough bond exposure to protect you in the dislocations. All right, so that's our message for today. I'm Don Rich, and you've just experienced a rich insight. I hope you've enjoyed it. May your beer be colder than the company you keep. We'll talk again soon. Thank you.